Our recommendation after the analysis of the company and the industry, we got a target price of 139 pesos with 70 cents, which in contrast to the current price of 124 pesos with 4 cents gives us an upside potential of 12.19%. This recommendation is there for a hold, and we are supporting this with a top short-term economic outlook. It will maintain its retail dominance, a strong regional presence in the soft drinks markets, as well as a strong cash generation and a healthy balance sheet. In terms of short economic outlook, we believe that FEMSA will decelerate its growth as most of its expansion will be financed from cash from operations, and as we think that weak economic data such as stagnated salary in Mexico and low GDP growth will lead to revenue to be flat in the following quarters, and it will therefore stop expansion and acquisition space. However, it will maintain its retail dominance. As of now, it has is a convenience store leader with 77% of market share in Mexico. As well, in terms of sales, it is just second place, just behind Walmex. And in order to keep their historical growth rates, it will go to the south of Mexico to increase their expansion. In terms of a strong regional presence in the soft drinks market, in the last 5 years they have had a lot of acquisitions, and we believe that as it is a Coca-Cola's product bottler, it will lead to expected volume sales of 4.6 billion unit cases by the end of 2018.
Well, for the evaluation, we use 3 different approaches: the DCF, the sum of the parts, and the relative valuation. So to start with the sales forecast, we divided the 2 business segments, FEMSA Commercial and Coca-Cola FEMSA. And for the FEMSA commercial sales forecast, we use 2 metrics. We can see it here. But well, one is the store expansion, and the other one is same-store sales. For the the store expansion, we use the FEMSA guidance, which they expect to have 20,000 stores by 2022. However, we do not expect this growth to be like in a straight line. We expect a little slowdown in the short term, and then it will go back and recovery. And the other one is the same-store sales, in which we use 2 metrics. One is the in-store traffic, and the other one is the average ticket per transaction, which we expect to go in line with inflation, as it has done for the last 5 years. And we do not expect an enhancement in the purchasing power of the consumers. So we created 3 scenarios. In our base scenario, we got a CAGR of 8.7% for FEMSA Commercial.
For COP sales forecast, we estimate both volume and average price per unit case. We expect a volume of 4,623 million of unit cases by the end of 2018. We can see that Brazil has the highest expected growth rate with 12.1%. For the average price, we estimate that by the end of 2018 it will be around 60 pesos, which represents a CAGR of 4.87%. We also came up with 3 scenarios for cold sales, and in our basic scenario, we arrived to a CAGR of 11.9% by the end of 2018. Let's talk about valuation models. The first model is relative valuation, which we assign a 20% of weight. We use 2 multiples, enterprise value EBITDA and price earnings. We weight these multiples to achieve a market multiple with 30 companies, 30 peers. And we weight it by sales share with both business segments. We arrive to the market multiples compared to FEMSA, and we derive a target price at the end of 2015 of 137 pesos.
Now, as for the DCF evaluation, a two-stage growth model was used. When the growth stage, we forecast in detail the free cash flow year to year up to 2025. We then, after calculating the expected equity value, we then adjusted it to the estimated net debt and estimated minority interest, and derived FEMSA 2050 intrinsic value per share of 143 pesos with 44 cents. Now, as for the DCF assumptions, we calculated a cost of equity of 9.96%, a cost of debt after tax of 5.2%, will led us to a WACC of 9.35%. We gave a 60% weight to this approach because we believe that share value relies more on its fundamental and therefore is unbiased by a bearish or adverse market. Now, as for the sum of the part, given that FEMSA is composed by bearish business segment, we believe that the sum of the part was suitable for the company, thus analyzing each business segment by separate, knowing that the beverage segment is different from the retail segment and that the handicap participation is not an operating business for FEMSA. So in order to obtain a target price, we value COF and FEMSA Comercio on the basis of 2015 estimated EBITDA and current enterprise value EBITDA by being conservative as to their willingness for investors for paying for the stock. Now, as for the handicap participation, we use expected values as an appreciation for both series, then multiplying for the Euro-Mexican forward rate to get the prices in pesos, then again multiplying for the total share outstanding, and adjusted it to the total ownership, which is 50% and 3%. Now, for the other businesses, it accounts for 2.5% of the total sale, so we were able to estimate the EBITDA for this segment. In this way, we calculated the implied FEMSA enterprise value, then after adjusted it to the estimated net debt and estimated minorities, we got a target price of 128 pesos with 29 cents. We gave a 20% weight to this approach.
Well, for the financial analysis, first we start with the growth. We have like two different stories with FEMSA. One is a non-organic, in which FEMSA has presented a very aggressive M&A strategy as well as a very strong expansion of the OXXO stores. But whereas the organic growth is not as remarkable as for the last 6 quarters, the average growth of the FEMSA Comercio is 2.3% and COF is only 18 basis points, which is below the inflation. In terms of margins, we can see that it has presented very steady margins, which are constant. I mean, for the last 10 years. We divided them into the two business segments. You can see that Coca-Cola FEMSA has higher margins. However, these are below the peers, and FEMSA Comercio has above the peers' margins. It has a healthy balance sheet. Assets are mainly composed by non-current assets. It has great liquidity, and it has room for more leverage if required. And one thing we noted is that it has a lower inventory turnover than the other peers. However, it has a negative cash conversion cycle, which none of the competitors have.
Risk factors. Well, we begin with the company risk. We consider market risk with the fluctuation of exchange rates. We also consider regulatory risk with the taxes. We consider economic risk with the Mexican and other countries' economies. We also consider an economic risk with new acquisitions, like the one in the Philippines. Risk by business segments. We consider in FEMSA Comercio, IT systems, risk. If it's a disruption, it may hurt sales. Competition. Mom and pops are big in Mexico and they oversight taxation. Drop in average ticket in traffic and not keeping historical growth. In Coca-Cola FEMSA, we also have the distribution risk, relationship with the Coca-Cola company, the consumer preferences, changing, and the price of commodities. In the valuation risk, we think two main factors may affect in the discounted cash flow, the terminal growth and the WACC, and in the sum of the parts, the expected appreciation of the Heineken shares. The risk in the Heineken stake, the not controlling Heineken decisions, and the Heineken global exposure. Thank you very much.
Well, yes, in the expected expansion of stores, which we account the pharmacies, which they expect to have increasing like 100 pharmacies by year. And however, we do not expect like a big growth because most of weak economic data for the short term or mid term, maybe we don't expect like the big increase. Very investors are very optimistic.
Okay, the other question is, what you mentioned, focusing around 20% of the total income of the company, and during the past, the situation of Europe has been very poor. Now or probably in the future, this can change. So, what do you think that this change will affect this sector?
Well, we think that the market is becoming consolidated with the huge companies in the beer market. Also here in Mexico, the growth of the artisanal beer. So we think if they would like, they could sell the participation if they see it like reachable. And we think in the future it's going to consolidate to bigger groups in the beer companies. We hope Heineken keep making acquisitions to future state.
Thank you all for your presentation. I've got a two-part question. One, in your assumptions, you have GDP increasing, you have your average ticket increasing, and you have 11% sales growth. What keeps you from having a buy rating on the company? And also, if GDP is a little bit higher than you guys expect, how sensitive are your models to acceleration of the economy?
Well, for the ticket, we expect it to go with just inflation, not with the GDP, because well, it has done like that for the last, in this case, it was 5 years or even 10 years. So we do not expect a big enhancement in the purchasing power of the consumers, which is very important in the retail market. So we do not expect a big increase. I don't know if this answers your question.
Well, you've got GDP increasing pretty nicely, and the average ticket was increasing nicely. It was slowly going up. So there's a lot of really positive signs. So what's keeping you guys from having a buy is what I was going to get into.
We have an upside potential of almost 30%. However, we believe that for someone that doesn't have the FEMSA stock, there are better opportunities in the market. There are other bottlers with better margins, and there are other retailers that are presenting more attractive growth rates.
Well, if we see the price movement of the stock, we can say that there has been some resilience in the company against the fiscal reform, these special taxes to drinks, and also a lot of the junk food that is sold on the OXXO stores. On the first glance, we can imagine that there will be a bigger impact on that. Why do you think that we haven't seen this in the price of the stock, and what are your views about the effect of the fiscal reform on both businesses, the beverage business and the retail business in the company?
Well, we believe that the tax reform have already been discounted by the market. We can see this because the stock price has moved in different ways. It was very correlated with the stock market index. So now it has separated a little bit. So we think that the stock price the market has already discounted this in the stock price. So this level, principally that we believe that FEMSA will keep growing with acquisition because the organic growth from, let's say, COF has been 0.66% in the last 4 quarters, and with COF only 2.2% in the last 4 quarters. So we believe that it's very discounted by the market.
And the future view about this? The effect is already finished, or?
Well, I would like to add something. In the case of COF, for the new taxes in Mexico, yes, it had already had a negative impact both the company, as my colleague said, strategy of acquisition. So, for example, expected growth in Brazil, it's making the company grow. So it's not only Mexico. It has a negative impact, but at the future, we think it will go.
Given your numbers in organic growth and the portion of Coca-Cola company owns in COP, and would it make sense for FEMSA to buy the participation of Coca-Cola company? And if so, what will be your rationale for the company to do so? And what will be the impact on the income statement and on the balance sheet?
Well, answering to your question, that it may be possible that maybe COF can buy from the Coca-Cola company the rest of the weight of the ownership. Well, we are not very positive in this way because we believe, for example, the TCF, and given that the organic growth has been slow in the last few quarters, we believe there are another opportunities, maybe like in the last year with the Philippines, that they got the first 1% of the stake in the bottle of the Philippines. So, in fact, in the TCF, we expected a terminal growth of 2.2%. This is because we believe that the company will mature with the Coca-Cola stake. So, we believe that it will not be a good idea for FEMSA to acquire the rest of the participation in COF.
Well, maybe I'd like to add that maybe it makes more sense for Coca-Cola FEMSA to use this cash which has available into investing in more bottlers around Latin America or even Asia, where they can find more growth than increasing their stake in their own company. So we believe FEMSA's objectives are more focused on still more expansion around the world, being the largest bottler, instead of growing inside, taking more stake in their own company.
Thank you.
Congratulations. In Mexico we have new reforms, and FEMSA maybe could be concentrated in the consumer sector. Do you suggest for the management that could be profitable to invest in other sectors to get more profit for the shareholders, or maybe it's better to specialize more the company in the stores or in the beverage?
1 minute.
Okay, so we think, for example, in the case of FEMSA Comercio, that it is still more room for growth. As of right now, there's a high penetration in the north of the country, and there's still more growth for the south. In fact, in our model, we assume that if they achieve the penetration they have in the north of the country, in the south, they can grow to about 23,000 stores, so there's still more growth. But as well, for example, in the case of pharmacies, they also have a big growth, as there's a lot of obesity here in Mexico, as well as diabetes and a lot of diseases that can help to boost revenues in the long term.
Okay, time. Thank you.
Thank you very much.